Did you know that the average millionaire has at least 7 streams of income? If you want to build wealth and achieve financial freedom, investing is the key. But where do you start? With so many options: stocks, real estate, crypto, index funds, it can be overwhelming. The good news: you don't need a fortune to begin, just the right strategy. In this video, I'll break down the smartest investment opportunities, how to minimize risk, and the secrets successful investors use to grow their money. Whether you're a beginner or looking to level up your portfolio, stay tuned. Investing can be the key to financial freedom, but for many, it seems complicated, risky, or out of reach. In this video, we'll break down the world of investing in simple terms and help you understand how to build wealth over time. Whether you're a beginner or looking to refine your investment strategy, stick around because this could change your financial future. Whether you're a beginner or looking to level up your portfolio, stay tuned. Section 1: Why investing matters. Why should you invest? The simple answer: inflation. Every year, the value of your money decreases due to rising prices. If your money just sits in a savings account, it's losing value. Investing allows you to grow your wealth faster than inflation, ensuring your future financial stability. Albert Einstein called compound interest the eighth wonder of the world. This means the earlier you start investing, the more your money can grow exponentially over time. Section 2: Types of investments. There are several ways to invest your money. Let's break down the most common types. Stocks. Buying shares of a company means you own a part of it. If the company grows, so does your investment. Bonds. Lending money to the government or corporations in exchange for interest over time. Real estate. Buying property to rent or sell at a profit. Mutual funds and ETFs. A mix of different investments managed by professionals. Cryptocurrency. A high-risk, high-reward digital asset market. Section 3: How to get started. Getting started is easier than ever. Here are 3 simple steps. Step 1: Open a brokerage account. Platforms like Fidelity, Vanguard, or Robinhood make investing accessible with just a few clicks. Step 2: Start small. You don't need thousands of dollars. Many platforms allow investing with as little as $10. Step 3: Diversify your portfolio. Don't put all your eggs in one basket. Spread your investments across different assets to reduce risk. Section 4: Investment strategies. Scene charts showing different investment strategies. Not all investments are created equal. Here are some proven strategies. Long-term investing: buy and hold. Holding assets for years to benefit from long-term growth. Dividend investing. Investing in companies that pay regular dividends for passive income. Growth investing. Finding companies with high growth potential. Index fund investing. Investing in funds that track the overall market to reduce risk. Section 5: Common mistakes to avoid. Many new investors make mistakes that cost them money. Avoid these common pitfalls. Emotional investing. Making decisions based on fear or greed. Not doing research. Always understand where your money is going. Timing the market. No one can predict the perfect time to buy or sell. Ignoring fees and taxes. High fees can eat into your profits, and taxes can surprise you if you're not prepared. Investing is not just for the wealthy, it's for anyone who wants financial freedom. By understanding the basics and making informed decisions, you can start building wealth today. The best time to start investing was yesterday. The second best time, right now. Bonds explained. A complete guide. Chapter 1: What are bonds? At its core, a bond is a loan. When you buy a bond, you're lending money to a company, a municipality, or the government in exchange for periodic interest payments and the return of your principal at maturity. Unlike stocks, which represent ownership in a company, bonds are debt instruments that provide a steady income stream. Here's how it works. When an entity needs money, it issues a bond to investors. This bond has a set face value, an interest rate also called the coupon rate, and the maturity date. Investors who buy the bond receive interest payments, usually semi-annually, until the bond matures, at which point they get their initial investment back. Chapter 3. Types of bonds. Not all bonds are created equal. Here are the main types of bonds you should know about. Government bonds, issued by governments to fund public projects. U.S. Treasury bonds are considered one of the safest investments. Municipal bonds, issued by state or local governments, often tax-free at the federal level. Corporate bonds, issued by companies to raise capital. These tend to offer higher returns, but come with more risk. High-yield bonds, junk bonds. These carry higher interest rates, but also higher risks. Zero-coupon bonds. These don't pay periodic interest but are sold at a discount and pay the full face value at maturity. Chapter 4. Why invest in bonds? Bonds play a crucial role in investment portfolios for several reasons. Stability. They provide a predictable income stream and reduce overall portfolio volatility. Diversification. Bonds often move inversely to stocks, balancing risk. Preservation of capital. Many bonds, especially government bonds, are considered safe investments. Passive income. Regular interest payments make them attractive for retirees or those seeking passive income. Chapter 5. Risks of bond investing. While bonds are generally safer than stocks, they are not without risks. Interest rate risk. When interest rates rise, bond prices fall. Credit risk. Some issuers may default on payments. Inflation risk. Inflation can erode purchasing power and reduce real returns. Liquidity risk. Some bonds are harder to sell quickly. Chapter 6. How to buy bonds. You can buy bonds through several methods. Brokerage accounts. Most platforms offer bonds alongside stocks and ETFs. Bond funds and ETFs. These provide diversification and ease of access. Direct purchases. U.S. Treasuries can be bought directly from the government via Treasury Direct. So, should you invest in bonds? That depends on your financial goals, risk tolerance, and time horizon. Bonds offer stability, passive income, and diversification, making them a valuable addition to many portfolios. Diversification, the key to wealth protection. Today, we're diving deep into why diversification is crucial, how to do it right, and the common mistakes you must avoid. Stick around, because by the end of this video, you'll know exactly how to build a bulletproof investment portfolio. Section 1. What is diversification? Diversification is the strategy of spreading your investments across various assets to reduce risk. Instead of betting everything on a single stock or asset class, you allocate your money across different investments so that if one underperforms, others can balance out the losses. Think of it as not putting all your eggs in one basket. Section 2. Why is diversification important? Why is diversification so powerful? Because markets are unpredictable. Stocks crash, economies slow down, and businesses fail. But when you spread your investments wisely, you lower the overall risk while maintaining the potential for long-term growth. Studies have shown that diversified portfolios tend to perform better over time with lower risk than those concentrated in a single investment. And for long-term wealth building, that's exactly what you need. Section 3. How to diversify your investments. So, how do you diversify your portfolio effectively? Here are the key strategies you need to follow. 1. Diversify across asset classes. Invest in a mix of stocks, bonds, real estate, commodities, and even alternative investments like cryptocurrency. 2. Diversify within asset classes, within stocks. For example, don't just invest in tech. Add healthcare, finance, consumer goods, and more. 3. Geographical diversification. Invest in markets beyond your home country. The U.S. stock market is great, but emerging markets have high growth potential too. 4. Time diversification. Dollar cost averaging. Instead of investing all your money at once, spread it over time to reduce market timing risks. 5. Industry and sector diversification. Don't be overexposed to one industry. A balanced portfolio includes sectors like technology, healthcare, energy, and finance. Cut to animation of different portfolios adjusting over time. A well-diversified portfolio minimizes risk while maximizing potential returns, keeping your investments strong through all market conditions. Section 4. Common mistakes to avoid. Now, let's talk about some critical mistakes investors make when trying to diversify. Avoid these, and you'll be way ahead of the game. 1. Over-diversification. Yes, it's possible to spread your investments too thin. Having too many assets can make it hard to generate meaningful returns. 2. Lack of research. Just buying random stocks or funds isn't diversification. Always research and choose assets with strong fundamentals. 3. Ignoring correlation. Some assets move together, reducing the benefits of diversification. For example, tech stocks and high-growth ETFs often crash together. 4. Forgetting rebalancing. Your portfolio should evolve over time. Check it regularly and adjust as needed. Section 5. Building a diversified portfolio example. Here's an example of a simple, diversified portfolio for a long-term investor. 40% in U.S. stocks, mix of large cap and mid-cap stocks. 20% in international stocks. 20% in bonds, corporate and government bonds. 10% in real estate REITs or property investments. 5% in gold or commodities. 5% in cryptocurrency as a high-risk, high-reward portion. Of course, this is just an example. Your ideal portfolio should match your financial goals, risk tolerance, and investment horizon. So there you have it. Diversification is the key to smart investing. It reduces risk, provides stability, and helps you build wealth over time. Mutual fund. Are you looking for a smart and simple way to grow your wealth? Mutual funds might be the perfect investment for you. But what exactly are mutual funds, and how do they work? Stick around as we break it all down in this in-depth guide. Chapter 1. What is a mutual fund? A mutual fund is a professionally managed investment fund that pulls money from multiple investors to purchase a diversified portfolio of stocks, bonds, or other assets. Instead of buying individual stocks, you own a small piece of a large collection of investments, reducing risk and making investing more accessible. Chapter 2. How does a mutual fund work? When you invest in a mutual fund, your money is combined with other investors' money and managed by a professional fund manager. Their job is to allocate the fund's assets wisely to achieve the fund's goals, whether capital growth, income generation, or stability. The returns you earn depend on how well these investments perform. Chapter 3. Types of mutual funds. There are several types of mutual funds, each catering to different financial goals. Let's go over the main ones. Equity funds invest in stocks and are best for long-term growth. Debt funds focus on fixed income securities, like bonds, and are ideal for stability and regular income. Hybrid funds, a mix of stocks and bonds, balancing growth and risk. Index funds, these track a specific market index, offering lower costs and steady returns. Money market funds, low-risk investments in short-term debt securities, great for preserving capital. Chapter 4. Benefits of investing in mutual funds. Why should you consider mutual funds? Here are some key benefits. 1. Diversification. Reduce risk by investing in multiple assets. 2. Professional management. Experts handle investment decisions for you. 3. Liquidity. You can easily buy and sell mutual fund units. 4. Affordability. Start with a small investment and grow over time. 5. Compounding benefits. Reinvested earnings help your money grow faster. Chapter 5. How to invest in mutual funds. Investing in mutual funds is easy. Here's how you can get started. 1. Set your financial goals. Are you saving for retirement, education, or wealth growth? 2. Choose a mutual fund type. Pick a fund that aligns with your goals and risk appetite. 3. Select an investment mode. You can invest via lump sum, one-time investment, or SIP, systematic investment plan, for disciplined investing. 4. Open an investment account. Use a brokerage, bank, or online platform. 5. Monitor and adjust, track your fund's performance, and adjust your strategy if needed. Chapter 6. Risks involved in mutual funds. Like all investments, mutual funds come with risks. Some key risks include market risk. If the stock market falls, so does your investment value. Interest rate risk. Changes in interest rates can affect bond-based funds. Liquidity risk. Some funds may have restrictions on withdrawals. Expense ratio. Management fees can eat into your returns. Always check the expense ratio before investing. Chapter 7. Mutual funds vs. other investments. How do mutual funds compare to other investments? Here's a quick breakdown. Mutual funds versus stocks. Stocks offer higher potential returns, but come with more risk. Mutual funds provide diversification and professional management. Mutual funds versus real estate. Real estate requires large capital, while mutual funds allow small investments and higher liquidity. Mutual funds versus fixed deposits. Fixed deposits are safer but offer lower returns compared to equity mutual funds. Chapter 8. Common myths about mutual funds. Let's debunk some common myths. Mutual funds are only for experts. Not true. Even beginners can start with minimal knowledge. They guarantee high returns. Mutual funds are market dependent, and returns aren't guaranteed. You need a lot of money to invest. Many funds allow you to start with as little as $10. Mutual funds are an excellent way to grow your wealth over time. But like any investment, they require research and understanding. Now that you know the basics, are you ready to start your mutual fund journey? Investing is one of the most powerful tools for building long-term wealth and achieving financial freedom. Whether you're just starting or refining your strategy, the key is to stay informed, diversify your portfolio, and remain patient through market fluctuations. Smart investment decisions today can secure a prosperous future. Now is the perfect time to take control of your financial future. Start by setting clear investment goals, researching potential opportunities, and taking action. If you found this information valuable, be sure to like, subscribe, and turn on notifications for more expert insights. Let us know in the comments what's your next investment move.